Hey everyone, welcome back to Corporate Decoder. Today, UPBD just filed their annual employee benefit plan report, and I'm seeing a big shift in their investment strategy from last year. Quick note, this is not financial advice, just my take on public filings for educational purposes. The big story here is a massive drop in plan assets, likely due to a big transition involving their plan administrators and investment managers. This filing is for the Upbound 401 Retirement Savings Plan, and it covers how the company's retirement funds were managed up to the 31st of December 2025. It is basically a yearly checkup on the health of the retirement plan for Upbound employees. Looking at the numbers, the first thing that jumps out is the dramatic change in the plan's assets. In 2024, the plan had over $245 million in net assets available for benefits. Jump to 2025, and that number is still healthy at about $259 million. But this is where things get interesting because how those assets are held changed dramatically. In 2024, the total investments were over $235 million. Now fast forward to 2025, and total investments are down to about $48.9 million. That is a huge drop, over 79%. So what happened to all that money? Well, a big chunk of that difference seems to be explained by cash in transit, which ballooned from zero in 2024 to nearly $200 million in 2025. The plan notes this was due to investments being liquidated prior to year, and because of a transition in their plan administrators and trustees. Basically, they sold a lot of investments to move money around, and it was in transit as of year. And let's look at how the investments themselves were structured. In 2024, mutual funds were the largest chunk with over $218 million. By 2025, mutual funds are a much smaller part of the pie, sitting at about $35.3 million. This indicates a significant shift away from mutual fund investments within the plan. Common stock also saw a decrease, falling from $8 million in 2024 to about $4.9 million in 2025. The stable value fund also decreased slightly from $8.9 million to $8.6 million. Now, let's look at how the plan's assets grew during 2025. The total investment income, which includes dividends and net appreciation in the fair value of investments, was about $26.7 million. On top of that, contributions from participants and employers, along with rollovers, added another $18 million. So, the plan saw a net increase of about $14 million in assets for the year. The notes to the financial statements give us more color on this big administrative change. It says that before the 1st of January 2026, Empower Trust Company was the trustee, and JP Morgan was the record keeper. But starting the 1st of January 2026, Fidelity took over as both trustee and record keeper. This transition meant a big move of assets from JP Morgan to Fidelity. The document confirms that around $200 million was in cash in transit at the 31st of December 2025 to facilitate this asset transfer, and these amounts were reinvested shortly after year end. The plan is a defined contribution plan, which means that individual participant accounts are credited with their contributions, company matching contributions, and any earnings or losses. The benefit a participant receives is based on the vested amount in their account. Employees are eligible to join after 3 months of service. Participants are immediately vested in their own contributions. For company matching and profit sharing contributions, participants become 100% vested after 2 years of service. There is also a change coming in 2026 where participants will immediately vest in company matching and profit sharing contributions made in 2026. A notable part of the plan's assets are the loans participants can take out from their own accounts. These loans are considered party in interest transactions. As of the 31st of December 2025, there were over $11.2 million in these notes receivable from participants. The interest rates on these loans varied from 3.25% to 8.5%, and the repayment periods for these loans range from 2026 all the way out to 2040. When it comes to how these investments are valued, the plan uses a fair value hierarchy. Level 1 investments are those with readily available, unadjusted quoted prices in active markets, like mutual funds and Upbound Group's own common stock. As of the 31st of December 2025, the plan had about $40 million in Level 1 investments, mainly mutual funds and common stock. Level 2 investments involve observable inputs, but not necessarily quoted prices in active markets. The plan had about $8.6 million in Level 2 investments, which were stable value funds. Level 3 investments rely on unobservable inputs that are significant to the fair value. For 2025, there were no Level 3 investments reported. The plan states they did not change their valuation techniques, and there were no transfers between these levels during 2025 or 2024. It is interesting to note that participants can invest in Upbound Group's own common stock, but there are limits. They can invest up to 10% of their deferrals, and their total investment in the company's stock cannot exceed 50% of their account balance. However, starting January 2026, they will no longer be able to make future investments in Upbound Group's common stock. This suggests a move to de-risk or diversify participant holdings away from company-specific stock. The filing also highlights party-in-interest transactions. These involve transactions with entities that have a relationship with the plan, such as the record keeper or trustees. In 2025, the plan incurred fees for services from JP Morgan and Empower, which are considered party-in-interest transactions. For reconciliation purposes with the Form 5500 filing, there is an adjustment for loans deemed as distributed. In 2025, this adjustment was about $68,500, leading to a net asset figure of $259.2 million for the Form 5500, slightly different from the financial statement figure. Overall, the financial statements show a healthy increase in net assets available for benefits in 2025, ending the year at over $259 million compared to nearly $245 million in 2024. This growth was driven by investment income and contributions, despite the significant asset rollover activity. Looking at this filing, the big story is the administrative transition and the resulting shift in how the plan's assets are held and managed. The move from JP Morgan and Empower to Fidelity as trustee and record keeper is a major operational change. While the net assets available for benefits seem to be growing steadily, the heavy reliance on cash in transit in 2025 and the planned cessation of participant investments in company stock in 2026 signal a deliberate move towards diversification and possibly a simplification of the investment structure. The company seems to be actively managing the plan's composition, which is a good sign for participant long-term benefits. The biggest risk I see is ensuring the smooth reinvestment of that $200 million cash in transit after year, and how this administrative change will impact costs and investment options for participants going forward. My biggest concern is what will happen to the investment options now that participants can no longer buy company stock. What I am actually looking for is a clearer picture of the new investment lineup under Fidelity and any associated fee changes. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Like, comment, subscribe, and join our Discord linked in the description.